Welcome to our introduction to the Chande Kroll Stop indicator. The Chande Kroll Stop is a technical analysis tool developed by Tushar Chande and Stanley Kroll to identify potential stop-loss levels for trading positions. Let's visualize how this indicator works compared to traditional fixed stop-loss strategies. A fixed stop-loss strategy sets a constant level regardless of market conditions. In contrast, the Chande Kroll Stop adjusts dynamically based on recent price action, providing more relevant protection. Notice how a fixed stop would trigger prematurely during normal price fluctuations, while the Chande Kroll Stop adapts to volatility. Let's compare fixed stop-loss strategies with the Chande Kroll Stop. One of the key features of the Chande Kroll Stop is its ability to adapt to market volatility. During periods of high volatility, the indicator provides wider stops to avoid being shaken out of positions by normal market fluctuations. And during low volatility periods, it tightens the stops to better lock in profits as the market moves in your favor. To summarize, the Chande Kroll Stop provides several key benefits for traders. The Chande Kroll Stop indicator consists of two primary components that work together to create dynamic support and resistance levels. The indicator is built upon two main components, the stop level and the ATR multiplier. To understand how these components function, let's visualize them on a price chart. The stop level is calculated using either the highest high or lowest low over a specified period, typically ranging from 10 to 20 days. For a bullish trend, the stop level uses the highest high value and creates a dynamic resistance level that adjusts as new higher highs are formed. The ATR multiplier is the second key component. ATR stands for average true range, which is a volatility indicator. This multiplier adjusts the distance between the stop level and current price based on market volatility. When these two components work together, they create dynamic support and resistance levels that serve as potential exit signals. When price crosses below the Chande Kroll Stop level, it generates an exit signal, indicating a potential trend reversal. In summary, the Chande Kroll Stop combines these two components to create a dynamic technical indicator that adapts to changing market conditions and volatility. The mathematical formula behind the Chande Kroll Stop indicator varies depending on whether you're in a long or short position. For long positions, the Chande Kroll Stop is calculated as the highest high over N periods minus the average true range multiplied by a multiplier value. For short positions, it's calculated as the lowest low over N periods plus the average true range multiplied by the same multiplier. Let's break down the key components of these formulas. The highest high and lowest low refer to the maximum and minimum price values observed over the specified N period look-back window. The N period typically ranges from 10 to 20 days, with 15 being a common choice. The average true range, or ATR, is a volatility indicator that measures the average price range over a specified period. The multiplier acts as a sensitivity control, determining how far the stop is placed from the price extremes. Now let's examine the typical parameter values used in the Chande Kroll Stop indicator. The N period typically ranges from 10 to 20 days, with 15 being a common default setting. The ATR multiplier usually falls between 1 and 3. Lower values create tighter stops, while higher values place stops further from price action. The ATR itself is typically calculated over 10 to 14 periods, with 14 being the standard setting to capture recent market volatility. Let's see how these formulas work in practice with a simple price chart example. For our long position calculation, we first identify the highest high over our look-back period, which in this example is 9.0. For our short position, we identify the lowest low, which is 2.0. Using an ATR value of 1.5 and a multiplier of 2, we can calculate the Chande Kroll Stop values for both long and short positions. The Chande Kroll Stop adapts to market volatility, providing dynamic support and resistance levels that help traders manage risk effectively. To implement the Chande Kroll Stop indicator on your trading platform, you'll need to configure several key parameters. First, locate the indicator in your platform's Technical Analysis Tools section. The first parameter is the look-back period, which determines how many bars are used to calculate the highest highs and lowest lows. Next is the ATR period, which defines the number of bars used to calculate the average true range. Finally, set the ATR multiplier, which controls how sensitive the stop is to price volatility. A higher multiplier creates a wider stop. After configuring these parameters, apply the settings to display the indicator on your chart. The Chande Kroll Stop will display as two lines on your chart: a red line above price for short positions and a green line below price for long positions. These stop lines adjust dynamically as new price data forms, helping you manage risk and identify potential trend changes. The Chande Kroll Stop generates trading signals when price crosses the indicator lines. A bullish signal occurs when price rises above the upper stop line, suggesting a potential long entry or exit from shorts. A bearish signal forms when price falls below the lower stop line, indicating a potential short entry or exit from longs. These crossovers represent significant breaks of dynamic support or resistance levels and often precede continued momentum in the new direction. Optimizing the Chande Kroll Stop indicator requires adjusting two key parameters based on your trading conditions. The ATR multiplier determines how sensitive the Chande Kroll Stop is to price movements. For more volatile markets or longer-term trading, use a higher multiplier between 2 and 3 to avoid premature exits. For shorter timeframes or less volatile markets, use a lower multiplier between 1 and 1.5 for tighter stops. The look-back period determines how many past bars are considered when calculating the Chande Kroll Stop. A shorter look-back period is more suitable for fast-moving markets. It provides more responsive signals but can create whipsaws during consolidation. A longer look-back period works better for trending markets with gradual movements. It provides more stable signals and fewer false exits. Here are specific parameter guidelines for different market conditions. For volatile or long-term trading, use a higher ATR multiplier with a longer look-back period to filter out market noise. For moderate volatility or medium-term trading, balanced parameters work best. In stable markets or short-term trading, use tighter stops with a shorter look-back period for quicker entries and exits. For intraday trading or scalping, use the most responsive settings with minimal delay. When optimizing your parameters, always test on historical data and adjust based on the specific asset and market conditions you trade. The Chande Kroll Stop indicator becomes significantly more effective when combined with trend identification tools. Let's explore a strategic approach to maximize your trading results with this powerful combination. The first step is to determine the primary market trend using indicators like moving averages or MACD. Next, add the Chande Kroll Stop indicator with its upper red line and lower green line. The key strategy is to only take signals in the direction of the main trend. In uptrends, indicated by price above the moving average, only use the lower green stop line for buy signals. Conversely, in downtrends shown by price below the moving average, only use the upper red stop line for sell signals. This approach filters out false signals and significantly improves the indicator's effectiveness by aligning it with the market's dominant direction. Let's compare the performance difference between using the Chande Kroll Stop with and without trend filtering. By aligning your Chande Kroll Stop signals with the primary trend, you create a more robust trading system that improves win rate and reduces false signals. The Chande Kroll Stop indicator has significant applications beyond generating entry signals. Let's explore how it functions as a powerful risk management tool. The indicator plots two lines, a bullish stop shown in green and a bearish stop shown in red. A primary application is to place actual stop-loss orders at or slightly beyond the indicator levels. During an uptrend, you would place your stop-loss based on the bullish stop line, protecting your long position. The second key benefit is that as the market moves favorably, the stop will automatically adjust to lock in profits. When the price rises, the bullish stop moves up as well, creating a trailing stop effect that adapts to the changing market conditions. The third benefit is protection during market reversals. When the price falls below the stop level, it signals to exit the position. The fourth key benefit is profit maximization during strong trends. The Chande Kroll Stop allows your position to ride the trend while progressively securing gains. By using the Chande Kroll Stop for stop placement, you create a dynamic risk management system that adapts to changing market conditions. This approach helps preserve capital during unexpected reversals while maximizing profit potential during strong trends. Despite its advantages, the Chande Kroll Stop indicator has several important limitations you need to be aware of. The first major pitfall occurs during sudden market gaps. When price jumps significantly between trading sessions, it can move beyond your stop levels before orders have a chance to execute. When a gap occurs, price can suddenly jump far away from your stop level. This means your actual exit price may be much worse than anticipated, leading to larger losses than expected. The second pitfall happens in choppy, sideways markets. In these conditions, the Chande Kroll Stop can generate frequent signals as price oscillates around the stop levels. These repeated signals can lead to multiple small losses as you enter and exit positions frequently. This is sometimes called the whipsaw effect and can quickly erode your trading capital through commission costs and small losses. Fortunately, there are several effective strategies to mitigate these limitations. Let's look at 3 key approaches that can significantly improve your results when using the Chande Kroll Stop. First, adjust your stop width based on market volatility. During high volatility periods, using wider stops can help avoid premature exits. Consider using the average true range to automatically adjust stop distance based on current market conditions. Second, never rely on the Chande Kroll Stop alone. Confirm signals with other technical indicators like moving averages or oscillators. This approach of requiring multiple confirming signals can significantly reduce false positives. Third, always consider the broader market context. Pay attention to key support and resistance levels, overall market trend, and trading volume. The Chande Kroll Stop works best when used within the context of the overall market environment. Let's compare a standard approach versus an improved approach that addresses these pitfalls. With a standard approach using default parameters, the Chande Kroll Stop generates many signals in volatile conditions. These narrower stops are frequently hit, resulting in numerous small losses and missed opportunities. An improved approach uses wider stops during volatile periods and filters signals using additional indicators. This results in fewer, higher quality trading signals and better overall performance. Remember, while the Chande Kroll Stop is a powerful tool, it should never be used in isolation. By understanding its limitations and implementing these mitigation strategies, you can enhance its effectiveness as part of your overall trading system. In this section, we will implement a complete trading strategy using the Chande Kroll Stop indicator. Here are the 5 key steps to implement this strategy effectively. Let's start by examining the first step, identifying the market trend using 50 and 200-day moving averages. When the 50-day moving average is above the 200-day moving average, we have an uptrend. This is often called the golden cross. Once we've identified an uptrend, we look for the Chande Kroll Stop line, which is green in uptrends and red in downtrends. Next, we wait for the price to pull back to the Chande Kroll Stop line. When price bounces off this line in the direction of the trend, it creates an entry opportunity. We place our stop loss slightly below the Chande Kroll Stop line. This provides some buffer to avoid premature exits due to minor price fluctuations. Now let's see how we trail our stop as the indicator adjusts. As the price continues to rise in the direction of the trend, the Chande Kroll Stop line adjusts upward. We trail our stop loss just below this indicator line, which allows us to lock in profits while still giving the trade room to breathe. Eventually, we exit the trade when price crosses below the trailing stop, or when we reach our predetermined profit target. Let's summarize the key points of this trading strategy implementation.